Hello everybody, I'm Clara Hermit and welcome to another edition of Breaking the Mould. With me, as always, is our Investment Research Director, Russ Mould. Russ, how are you?
Bit of a cold, promise I won't come too close.
Okay, so apart from the cold,
yes.
Russ, what is the fuss?
Okay, we've got three things coming up. We've got home shopping, we've got brain power, and, sorry about this, central banks.
Central banks? Don't we normally try and steer clear of central banks?
We've got some feedback from you lovely people who watch this regularly. You all say you love the company stuff, you're not too fussed about the macro, but we mustn't forget that central banks are still exercising great influence on all asset prices. We haven't done it for a long time. We've got the Bank of England statement coming up. Just time for a really quick one, I promise.
Come on then, what are we looking for?
Well, this is going to really blow you off your brand new chair. No change in interest rates at 0.5% and no change in QE at 375 billion is the market forecast.
I've got to be honest with you, Russ, it doesn't sound particularly grippy.
Okay, bear with me, don't end the interviews just now, because the really important thing to watch will be what the bond market does in response. Now, to fund its borrowing requirements, the government sells bonds, loans, and they're actually called gilts, and at the moment the 10-year gilt offers a yield of 2.4%. So if you were to buy one of these bonds today, that's what you get every year and your money back at the end. Now, if you think about it, relative to cash at 0.5, that doesn't look too bad, particularly given you're definitely going to get your money back at the end. And also, people have been buying shares, this reach for yield that we've talked about, because they offer in some cases a higher dividend yield still. So if you think about it, if interest rates start to go up, the government will have to offer a higher interest rate on the bonds to make people want to buy them, and share prices, or companies may have to respond by offering a higher dividend, or maybe seeing their share price go down so the yield goes up, so that they look fairly competitive. So there is a big knock-on effect here, and in the end cash is the least risky, followed by bonds, followed by shares. And so if interest rates do start to go up, there will be a logical knock-on effect in terms of what can happen. And this chart behind us actually shows it. There's a green line for interest rates, a red line for the 10-year bond, and this shows what happens to the share prices of the FTSE all-share companies when rates start to go up. And as you can see, eventually the black box works its magic and share prices start to run out of steam. Now the secret here is eventually, doesn't happen straight away, and so yes, wait stops trains, but as soon as the Bank of England does raise rates, when it raises rates, the effect might not be instantaneous, but it's definitely a trend to watch. Look at the 10-year gilt yield, and on the 22nd, 2 weeks after the meeting, also look at how the Monetary Policy Committee voted. It was 7-2 against a rate rise last time. It had been 9-0 for ages, so let's just see if the balance of power starts to change.
Okay, Russ, let's get back to the company nitty-gritty. Can we start with brain power?
Brain power. Imperial Innovations, 15th of October, full year results. Fascinating company. It's an intellectual property or IP incubator, and it basically provides funding and expertise to small startup companies. Bit like Dragon's Den, I suppose, in all fairness, and it's got very close links to Imperial College London. Now, back in the summer, it raised £150 million to invest across its very large portfolio of companies, and in the end, the game plan really is to get these up and running, get them generating revenues and profits, and possibly either sell them to a bigger company or even float them on the stock market.
Has it managed to get many firms floating on the stock market?
There was a big one this year called Circassia. It's a drug development specialising in hay fever and dust mite allergies, so potentially big stuff.
Yeah.
And the company's worth, according to the stock market, £575 million today, so that was a huge success. And following on from the Ixico flotation on AIM last year and Oxford Immunotech's float on America's NASDAQ, that's a huge affirmation of the business model, and the shares have gone from 360 to 460 pence this year.
Wow, that's pretty good.
Yeah.
But our last firm hasn't done quite so well, has it?
Not enjoying itself. N Brown, home shopping the final theme. We've got interims on the 9th. Now the September trading statement was nothing of beauty. Sales down 4.6%, down from up 2.25% in the first quarter. So quite a bad set of figures, or unexpectedly bad. Partly explains why the shares have gone from £6 to £4 recently. So the trading statement that accompanies the interims needs to be pretty strong. Now, despite the September letdown, management stuck to a full year profit forecast pre-tax of around 100 million quid. They're putting great store in a second half marketing push featuring Lorraine Kelly and Kelly Brook. I'll defer to my expert here for a commentary there. And so we'll see how that plays out. And also boss Angela Spindler is in fact looking to increase the company's high street footprint to supplement its online strength.
Okay, thank you, Russ.
Pleasure.
That's been Breaking the Mould for this edition. We'll be back with you very soon indeed. Until then, take care and goodbye.